Hi, my name is Stuart Weems and welcome to the Investably podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to talk about pooled super products versus unpooled super products and how they differ, particularly regarding to capital gains tax, and how unpooled super products potentially allow you to avoid paying any capital gains tax on your super balance for your entire life. And look, there's been a big uproar, I guess, about the government's proposed tax on unrealised capital gains for balances over $3 million. And the concern is that it sets a dangerous precedent in that what's to stop them taxing unrealised gains in other environments? But the irony here is that most super members, that is, super members that are in what's called pooled super products, already pay tax on unrealized capital gains. That is, that tax is subtracted from the unit price every single day at the end of each day. So it's funny that we have an uproar around unrealized gains, but it happens in pooled super products, and it kind of has to happen. So today I wanted to unpack that because the key question that I get regularly in the podcast through the Q&A is it worthwhile paying higher fees to go into an unpooled product? And it's going to depend on many factors, which I'll talk about today, but I've done some financial modeling. I've looked at our client accounts and used some of that data to do some financial modeling, and hopefully I can put this issue to bed once and for all. But before we do that, let's talk about how pooled super products work. Pooled super products work by combining a pool of investment assets. And instead of you owning those assets directly, you own a share of those assets. So a unit, if you like. So if you decide to invest your super in high growth, that's fine. You will buy units in the high growth super investment fund. And essentially what they'll do is they'll value those units at each day. And what they then need to do is net off any taxation liabilities, both realized and unrealized. So realized is if they've traded any shares or made any changes to investments and there's been any capital gains or losses, they obviously need to take account of that. But also, at the end of the day, if there's unrealized capital gains, they need to also provide a provision for that tax as well. Because the problem is if they don't do that, and then someone leaves that fund without paying their share of the tax on their balance, then the remaining members of that fund are left holding the bag and paying for that full liability. So of course that's not fair. To make it really fair for a pooled product is that what we need to do is reduce everyone's balance. So if and when we either sell that investment or that member leaves and crystallizes as a result of taking monies out of the fund, crystallizes that capital gain, they're going to stump up with their share of the liability. So therefore, in a pooled super product, doesn't matter about fund turnover. It doesn't matter, except for fees. From a taxation perspective, it doesn't matter if we're buying and selling investments or not, because the taxation is always going to be included. Whereas we know outside of super, for instance, if we have investments, we're quite loath to keep trading them and moving them all over the place because we know it triggers capital gains tax, right? Property is a perfect kind of analogy of that. If we have an investment property with a lot of unrealized capital gains in that asset, we don't want to go and sell it because we're going to have to pay this massive CGT bill. And the longer we can delay it or even avoid it, the better off we are from a financial perspective. And that's true with all aspects. And this is one of the downsides to a pooled super product. So how do you get around this? Well, the only way to get around this is not to use a pooled super product, of course. I think the answer was already in the question. Essentially, you need to own the underlying assets, or your super fund, your super account needs to own the underlying assets that you're investing in, whether that's ETFs, direct shares, property, bonds, whatever it is, you've got that direct ownership. And you can achieve that either by using a wrap platform. And I'll direct people to episode 326, which I published in October 24, so October last year, where I did a deep dive on wrap platforms. So certainly check out, if you don't know what a wrap platform is, its advantages, disadvantages, all those sorts of things, or by establish a self-managed super fund. So they're the two options to avoid a pooled super product, wrap or self-managed super. Now, how does this help? Well, essentially, How this helps is that you will have all your super invested in a particular portfolio, either in a wrap or in a self-managed super fund. And then when it comes time to converting into pension phase, so that's when you're 60 or 65, 60 and not working, or 65 irrespective of your working status. You then can convert your balance, or at least today up to the transfer balance cap, up to $2 million per person. You can convert that $2 million into pension phase. Any unrealized gains that are in that portfolio essentially disappear, and you don't end up paying any tax on them. So essentially it means that if you're 20 years old today, you can establish a wrap product, you can go and invest in a bunch of ETFs, you can then hold those ETFs forever. Hopefully there's a survivorship element to this. Hopefully those ETFs are in existence in 40 years from today. Anyway, you can own those ETFs forever. You'll pay tax on, obviously, distributions, at 15% over that period of time, but you'll end up, hopefully, accumulating a lot of unrealized capital gains, and you won't pay any tax on those capital gains. Pretty substantial, right? It's pretty amazing. Now, if you're in a wrap product and you switch wrap platforms, typically what that means is the trustee of the super fund changes, which is the legal holder of those assets, even though it's on behalf of the members of that fund. And that is a tax event. So that's a taxable event. So really, if you're going to use a wrap platform to avoid paying capital gains tax, it's only going to work if you stay with the same wrap provider for the rest of your life. A self-managed super fund will avoid it in totality, but it's more expensive product, which I'll get into the fees a little bit later. But within a self-managed super fund, you've got complete flexibility. You can change wrap providers. You can use something like BetaShares Direct, for example, which is a ASX trading offer or product that BetaShares have marketed that doesn't charge any fees or brokerage. But keep in mind, if I had a self-managed super fund and I'm using share trading platforms, the big downside is returns reporting. So, I can't work out how my portfolio has performed unless I keep really detailed records and spreadsheets, because it's not only just working out how are the existing assets performed, but if I've bought and sold assets previously in previous years, that's not reflected in my current portfolio. So one of the big benefits that wrap platforms provide is very detailed returns reporting. And that's a critical element, I think. I mean, if you can only manage what you measure. And so if you can't measure performance over time, how can you benchmark it? How can you manage it? It's a really important aspect. So as I said, you're in your 20s, you start a super fund, you start buying ETFs, you hold those ETFs till you're 60, you sell them, all the capital gains tax disappears. Sounds like a good outcome, but how much is that really going to save you? Well, there's a bunch of factors that are going to impact the gain, and that's why it's really difficult to kind of ascertain. As I said, I've done some financial modeling, which I'll share with you in a second, but that's the challenge, right? Everyone's situation is different. The younger you are, the longer the runway you have, the more chance your situation is going to change and things are going to change. So it is a really difficult thing to ascertain. I just want to put that out there right from the get-go, because there's some things I talk about in the podcast and I say it's a no-brainer. We can ascertain this. It's black or white, I should say. This is not the case with this factor. You're just going to have to make a sort of your best estimate, I guess, in terms of whether it's going to suit you and what benefit you might gain from a pooled versus unpooled super product. So the first factor is sort of timing of contributions. And that really depends, of course, typically on a person's income. If they start work very early and they're highly paid right from the beginning, they're going to be contributing a lot more sooner. And, we know investment returns compound over time, and that could be a very big deal versus people that, start out a bit later in life, either because they've immigrated to Australia or, maybe they've been doing other things. And, if they've got relatively low super balances for their age, then there's going to be less unrealized gains, of course. It takes our clients typically early to mid 40s, their super balance reaches about 250,000. So it's a couple of decades of work to get to that point. By their early 50s, it's doubled. It's ended up being around about 500,000. And then we see it double again by age 60 to about $1 million. Now, our clients tend to be higher income earning people. So it's not that the balances I just shared aren't that relevant necessarily, but just how compounding returns really develop over time. And it's really not until probably the last 10 or 15 years that the returns are far more important than the contributions in terms of percentage wise and also in terms of dollar terms, just because of how returns compound over time. So, therefore, the first thing to ask yourself is your super balance relatively high for your age or relatively low? Because that'll give you a bit of a hint of whether it's worthwhile to avoid a pooled super product. The next consideration is number of years until retirement. You know, the example of the 20-year-old, of course, they've got a really long runway. Chances are they're going to have heaps of unrealized capital gains. It's going to be worthwhile for them. Whereas if you're just 5 years away from retirement, switching now is probably not going to change too much. Portfolio turnover is another consideration. So it's really how much are you chopping and changing investments? For instance, a lot of actively managed funds tend to have more than 100% portfolio turnover in any one year. So that's important, right? When you compare an active managed fund to an index fund like an ETF, you've got to really look at portfolio turnover, because even if the returns are the same, the tax outcomes are going to be completely different, because for the active fund manager that has 100% turnover, 100% of the returns will be taxable in that year, versus the index fund, it's going to be a lower proportion, of course, depending on what that investment is. And index funds tend to have turnover around about 1% or less, just from rebalancing. Now, they can be higher in particular years, and we've seen that in one of the Vanguard funds, Vanguard International Hedged, for example. In the managed fund version, the turnover has been quite high this year, so it can change from year to year. But if you look at the Vanguard International Unhedged Fund, over the last 5 years, the fund's returned 15%, and that consisted of 5.4% of income and 9.6% of unrealized capital gains. So in a pooled super fund, that 15% is being taxed, the income at 15% and the capital gains at 10%. Whereas in an unpooled fund, only the income is going to be taxed and the unrealized capital gains aren't going to be taxed if you don't sell the investment. And lastly is just a catch-all consideration, change in circumstances, I've called it, but whether you will need to switch super funds because of a change in career or to access employer-provided benefits, you go through a divorce or a relationship breakdown, you stop contributing because you work overseas for a period of time. There's so many things. I can share those experiences that over the last 20 years, there's been so many clients go through so many changes that I think that's the one thing that should be expected is unexpected change to some degree. That's why it's difficult to sort of forecast these things. So it's really super balanced timing of contributions, time until retirement, portfolio turnover, and just a general change in financial circumstances. And for some of those things, they're going to be a bigger deal for some clients in some situations. I mean, some people will be in a situation where they don't expect, it's very unlikely that their circumstances are going to change. Well, they can kind of discount that one. Okay, so what I wanted to do then is build, obviously being very focused on making evidence-based financial decisions. What I did is I reviewed 30 client accounts, just random client accounts. These accounts were established between 4 and 15 years ago. The average life of the account was 8 years. Now that's relevant because that gives us a sense of longevity and how things change over time. And the selection was diverse. There's some clients covering different situations, circumstances, contribution histories, balances. I think it's a really good sample size, if I say so myself. Based on the WRAP investment portfolio reports, the average return composed of 60% unrealized growth and 40% of income and or realized gains. The highest percentage of unrealized gains was 70%. One account had 70% of returns, and the lowest was 40%. So we know the unrealized gains component is going to be significant, if you like. So conceptually, if we say that the return on super is, say, 7%, and if 60% of that 7% total return is from unrealized capital gains and 40% is from income, just like I found with my clients, remember that in a pooled super fund, the unrealized capital gains, they're still going to take out 10% of tax for those unrealized gains. So therefore, the total tax payable on that 7% is 0.84%, which means its after-tax return is 6.16%. However, in a non-pooled product, of course, we don't pay tax on those unrealised gains, and if we convert into pension phase, we'll never pay tax on those unrealised gains. So the after-tax return is 6.58%. So 6.16 versus 6.58, you've got 0.42% of a return higher, almost 1%, half a percent, higher just from the tax outcomes. So you can start to see it really can have sort of a relatively large compounding impact. Now, before I get into the financial projections, and I did a couple of scenarios, I just want to talk about fees. So what I did is compared a group of pooled products compared to unpooled products from a fee perspective. Because what I'm going to do next in the financial projections is I want to isolate just the impact of fees and tax outcomes, holding returns constant. And we'll get into returns and long-term returns in next week's episode. So in terms of pooled options, I compared Vanguard Super. I did a podcast on Vanguard Super a few weeks ago. And Australian Super, both in high growth. I compared those two just because Australian Super tends to be the best performing. Vanguard Super is certainly the lowest cost fund. And then I compared 3 unpooled options. I compared a self-managed super fund, a wrap platform, and I've written about podcast about wrap platforms previously, and then also Australian Super's Members Direct option. Now, a lot of these industry funds, or more than Australian Super at least, offer what's called Members Direct. The name can be different, but essentially these act like very basic wrap platforms. That is that they're unpooled, so you get the benefits of avoiding paying capital gains tax on any unrealised gains when you transfer into pension phase. But the investment menu typically is very limited. So it doesn't have a very wide investment menu, and it doesn't include indexing strategies like fundamental indexing, dimensional indexing. And, I'll give you an example in a little while about another indexing strategy I talked about at the beginning of the year that we could use in the Australian market. It doesn't have that. So the best way that I would use a Members Direct option would be to invest 100% in a diversified ETF. So specifically, and looking at the investment menu that Australian Super offers, I would invest 100% in VDHG, so which is Vanguard High Growth. And essentially, it's exactly the same option that Vanguard Super uses for its high growth option. So what we're doing is really comparing the same investment approach, but in 2 different environments, if you like, that are going to have different fees and then different tax outcomes. And so you can refer to there's a table on the blog on the website. Of course, link is in the show notes as always. So you can refer to that table where I've done a fee comparison for balances at 100,000, 250,000, 500,000, a million. Now, if you're looking at that table and, you're thinking, well, how much would a wrap platform cost me? Best to aggregate your spouse's balance with your balance because they will offer discounts at a family level. So, if you've got 250 and your spouse has got 250, look at the $500,000 column, for instance. And so I've compared the fees there. Looking at, say, 500,000, for example, in terms of a balance, Vanguard Super is going to cost you about $2,000 a year, Australian Super about $3,000 a year. In an unpooled environment, Australian Super Members Direct about $2,000 a year, a wrap platform about $3,000 a year, and a self-managed super fund about $5,000 a year. When you're looking at all the fees, including admin, accounting, investment fees, and so forth. So it's important that what we want to do is say, okay, if we're going to pay slightly higher fees, if we are going to pay slightly higher fees, and we get some tax benefits, are we still better off net of fees? Or net of the net outcome, of course, tax and fees. And so anyone that's been listening to this podcast for any reasonable period of time would know that I love to get into the numbers and look at the evidence and do the financial projections. And so I did some financial projections for really 3 scenarios. And again, I assume that the pre-tax and pre-fee returns are 7%. So I've held investment returns constant across all of these options, these 4 options that I compared. And actually in the comparison, I didn't compare self-managed super fund just because it's a lot more expensive and probably doesn't suit a lot of people unless they're going to have direct property investments, for instance. So really I compared the 4 products, 2 pooled and 2 unpooled products. So the first scenario was for a 20-year-old just starting out in their career. Of course, they're probably going to benefit the most from avoiding unrealized capital gains because they've got a 40-year investment horizon. And if you invest well, you hope that, you're going to avoid or you're going to accumulate a lot of unrealized capital gains. So the 20-year-old had a starting balance of $15,000. I just made some assumptions around contributions over their lifetime. And what I've done is calculated what their super balance would be in today's dollars by age 60. And Australian Super Members Direct, because obviously it's the lowest fee environment, but also has the same tax outcomes as a wrap platform, obviously yielded the best outcome. So $1,109,000 was going to be the balance, compared to a wrap platform which was $41,000 less at $1,068,000. So there's not a huge difference between those two, but certainly Members Direct came out lower cost. Vanguard Super was just slightly over $1 million, $1,020,000, and Australian Super High Growth under $1 million, about $990,000. So about $120,000 less than Australian Super Members Direct. Now, $120,000 in today's dollars is at least for most people, a year's worth of living expenses. So pretty considerable when you think, okay, that we're comparing sort of the same super fund, but different options within that fund that are going to have different fee profiles and different tax outcomes. It makes for an interesting comparison. The second scenario that I compared was a 35-year-old with a relatively healthy super balance that is going to maximize concessional contributions until they're 60 years old, for the next period of time. And what I wanted to do there is say, well, someone that's kind of in their career, they've just started accumulating a reasonable balance inside super. How does it compare for them? So again, the Members Direct came out the best option, wrap, Vanguard, and then Australian High Growth in all these scenarios. So wrap platform was $44,000 less, so just over 1.7 for the Members Direct, and the wrap platform was $44,000 less. Vanguard Super $133,000 in today's dollars, so yes, another year's plus worth of living expenses. And Australian Super High Growth was $185,000 less, almost 2 years worth of living expenses there, so pretty considerable. And the last scenario was a 50-year-old, so 10 years away from retirement. What I wanted to do there is, explore how the time to retirement has an impact on the potential savings that, as capital gains tax savings. 50-year-old, $500,000 balance, maximising concessional contributions, retiring at 60 was the scenario. Okay, in this situation, almost $1.1 million was the answer for Members Direct, and a wrap platform was $16,000 less. Vanguard Super $43,000 less, and Australian Super High Growth about $60,000 less. So again, not small savings, but again, probably not going to really materially change your retirement outcome. That's not to say that you shouldn't make a good decision and try and find the best solution for you, both from a tax, fees and returns perspective. But I thought it was interesting to complete those comparisons and really put some numbers around, what is the benefit of avoiding capital gains tax, and what sort of product do I need in order to achieve that. Of course, returns is another component to that as well. Now, I'm not here to push wrap platforms or anything like that. I'm here just to look at the pros and cons. There's two things that are going to be certain: tax and fees. Returns are uncertain, and so we've got to take that into our analysis. But today, what we're doing is really comparing a few different fee environments, and those different fee environments have different tax outcomes. And all we've done is just isolated those two differences, those two attributes, if you like. And I think, it's a fair comparison to do because they're certain, unless the tax legislation changes, of course. But, in terms of how those are treated from a taxation perspective, I don't think that's ever going to change. There are other benefits, though, of a wrap platform that I think are worth kind of highlighting, particularly as we get closer to the super review for 2025. As I said, I've written about super products more recently. Again, that's episode 326. And I wrote about that last year. But, one of the benefits is that you've got full transparency over, what you're investing in. So it allows you to sort of adopt maybe a more sophisticated investment approach than, say, Vanguard, which is all traditional market cap indexing. You can make sure that you're going to minimize investment costs, using low cost, sort of very transparent ETFs and indexing sort of strategies and the like. And that's why, just going with one index strategy doesn't always deliver the best returns or the lowest risk portfolio either. For instance, early this year, I suggested, one way to reduce your exposure to the banks and miners in the Australian market was to use products like X20, which is EX20, is the ticker code for BetaShares ETF that invests in the top 200, excluding the top 20. And over the 25 financial year, X20 returned about 16% versus 13.7 for the broader market. So that idea that I shared at the beginning of the year, I mean, it's very short term. I'm not attached to, what happened just in the last 6 or 12 months, but it does indicate that adopting a variety of indexing strategies, just not traditional market cap, as Vanguard does, can expose the portfolio to low risk and higher longer term returns. So I guess what I'm saying, the cheapest product is not always the best. Now, having said that, to manage your wrap portfolio, you've got to have either the confidence, knowledge, and experience to do it yourself, or you've got to have the guidance of a trusted financial advisor. So again, we're not necessarily comparing apples with apples because you can invest in Vanguard Super. You don't need any knowledge, or advisor relationship to do that. So let's wrap it all up then. Excuse the pun. My conclusion is if you are already working with a financial advisor on other matters, so there's got to be more than just super that your advisor is helping you with, then paying wrap platform fees, I think, is justifiable. The higher fees relative to Vanguard Super is justifiable in order to achieve those tax benefits in most situations. The key underlying assumption there is that the advisor that's working with you is going to be able to produce comparable pre-tax, pre-fee returns. And that's just going to depend on, the methodologies they use and those sorts of things. However, if you are not using a financial advisor and there's nothing else they can really help you with other than looking after your super, then I think using a low-cost option like Australian Super's Members Direct option that allows you to utilise the benefits of avoiding capital gains tax, capital gains on unrealised gains when you transfer into pension phase, and invest in something that's very low cost in terms of low percentage investment fees like VDHG, as I described, as what Vanguard Super uses in their pool product. So as long as you don't muck around with it and try and get too tricky, if you don't have the skill and experience to do that, that's my only concern here is with a Members Direct option. It might encourage people to be a little bit more inventive than they need to be and sort of try and outsmart themselves really to the detriment of future returns. So if you're willing to just go, okay, I'm going to put everything in a diversified ETF, then that's Australian Super Members Direct is probably the best option from a fees and taxation perspective only. The returns element still needs to be added, which I will cover off next week in my 2025 super review. And that's when I'll address the super returns components. You've really got to listen to this episode in conjunction with next week's episode to have a full picture. But anyway, there you go. I just wanted to pull apart all that data and put some evidence around the decision making, around the context of, is it worth paying higher fees than a low cost provider like Australian Super in order to avoid the tax? And I think it would have been before Vanguard Super joined the market in the last 2 or 3 years. It's probably before, if I did that analysis a few years ago, it would be a no-brainer. But I think this shows that, a very low-cost provider like Vanguard Super certainly has its place and will certainly help many Australians save a lot of money. Okay, let's get into some questions. Probably only one. The first question is from James. James writes, I was recently recommended to listen to your podcast by a former client of yours. So I've since been listening to your podcast daily for the last 3 months. Oh, you've had an enjoyable 3 months, James. Your content has been exceptionally great and eye-opening experience for me who is yet to purchase their first home. Thanks, James. I'm currently in a predicament. As a 28-year-old, I would like to enter the market as soon as possible. However, I have heard you say multiple times that buying your forever home as soon as possible would be the best. Right now, my financial situation does not allow me, as my current budget as a single investor would allow me to buy a house for around $1 million. Some more information about myself. My annual income's 150,000 before tax. I currently working in Brisbane, but grew up in Sydney. My partner is from Melbourne. Your partner sounds smart. And we've only just begun our relationship less than a year ago. I want to enter the property market to maximize capital growth with an investment grade property. Yet, of course, I want to buy my forever home as soon as possible. Would you rather start with an investment property and then in a few years' time buy my forever home? Or would you wait a few years and buy a forever home with your partner once a significant deposit can be saved? Also having difficult deciding where to choose which city would be best to buy my first investment property if I was to go with option one. I could reside in Brisbane and I think it would probably be easier if I was to buy here. What are your thoughts? Understand that any information is not advice but only guidance. Would love to hear your thoughts about this topic. Look, it's a great question, James. As a general, yes, I would like to buy the forever family home as soon as possible. But that's impossible typically for people that are just starting out on the property ladder or just starting their investment journey. I wrote a blog a few years ago called Buy Your Dream Home, a Stepping Stone Strategy Could Be the Solution. It's the podcast didn't have a episode number, but there is a podcast there about it. But if you Google Pro Solution and Stepping Stone, Pro Solution Stepping Stone, it'll take you to that blog. It might be an interesting read for you and people in situations like you. But it's impossible, typically for people that are just starting out to go right from nothing to forever family home. So in your situation, James, 100%, it's just about getting into the market, getting a foothold into the market, buying well, buying something that you don't need to buy a bargain. Like you don't need to, it'd be great to buy a $1.1 million property for $1 million, get something cheap. But that's difficult to do, particularly in a pretty buoyant market. And if it's a good quality, not impossible, but if it's a good quality asset, you normally have to pay a fair market value for it. But so when I say buying well, buying something that's in really good quality, really good location, all the investment grade attributes that I talk about. In your situation, you want to, because you might sell that property in a relatively short term. Hopefully you don't. If it's a great investment, hopefully you can keep holding on to it. But you just never know how things change, situations, borrowing capacities, incomes, all those sorts of things. So if I was in your shoes, I'd be thinking about what if scenarios. And so what if you bought this property and then sold it in 5 years' time to crystallize the equity so you've got a greater deposit to go and buy your forever home? In that situation, you want to minimize capital gains tax, of course. So I would buy in Brisbane because not only do I think the growth will be pretty reasonable over the next period of time leading up to the Olympics, not one of those that really wants to jump on the Olympics bandwagon in terms of property price growth, but it will certainly add to overall sentiment. I don't think it really changes the market very much. So it's not about a factual change in the market, but certainly from a sentiment perspective. So I think it would be a good market. But really the thing that attracts me, and I've spoken about this before, is that if I was in your shoes, James, I'd go and buy a great investment grade property. I'd buy something with a terrible kitchen and bathroom, and something that needs a bit of love, but structurally sound and in a location that has the most valuable land possible within your budget. I'd then go and occupy that property. I'd spend 6 months renovating it, cosmetically doing up the kitchen and bathroom, floors, maybe window furnishings, maybe internal, external paint, these sorts of things. These are going to cost money, of course, but they're not necessarily huge ticket items. You can do them relatively cost effectively. As a result of doing that, you change your electoral roll, licenses, get utilities connected, all those sorts of things to build that evidence and keep that evidence to demonstrate that it was your principal place of residence, your main residence. And then after 6 months, once I've done those cosmetic improvements, I would then go and rent out the property. And you didn't say what you're doing at the moment in terms of renting with your partner or whatever you might be doing, but go back to your normal life. The benefit of that is then you've got 6 years that you're not going to pay any capital gains tax on this asset, as long as you don't claim another main residence, of course. Whereas you're going to get the full negative gearing benefit, and by doing the cosmetic renovations, you've hopefully generated a bit of equity in the property as well, and also improved its rental income profile as well. So you're ticking a lot of boxes there, James, by doing that, and that's exactly what I would do if I was in your shoes and get into the market. Do it yourself. It's an early relationship. Who knows how that goes? Hopefully it goes well, of course, but I think it's probably too early necessary to combine financials, but I think that's the approach that's definitely the approach that I would take if I was in your shoes. Chances are, hopefully in 5 years' time, depending on your capacity and situation, you might be able to afford to buy that forever home. Worst case is if you need to sell that existing property, worst case is it's done well for you and you don't pay any capital gains tax. I think it's a pretty good outcome. Thanks for the question, James, and thank you for the feedback on the podcast. I'm glad you enjoying it. Hopefully you continue to enjoy it. And a little over time, so that's it for me for this week, and until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.